Harsha, you spoke about investing 20% of your take home salary into the schemes which you manage. And plus, all your investments are in the mutual funds, especially in Kotak Mutual Fund. And then you can hardly get a chance to own any stocks in your demat account, including your family members. But still, there is a debate, will fund managers add value to individual's portfolio? So why not go just passive versus active? Or can I do it all by myself? Is there any value add done from the fund managers? How do you answer
Yeah.
this?
I have a different take on this, right? There has been a long debate on whether actives are really adding value or not. Should we go just the passive? The debate has started because there is a feeling that actives may not outperform the respective benchmarks, right? If that is the starting point, why are you going into passives? Because passives by definition and by construct are always going to deliver less than the benchmark, right? So you are going to get 100% guaranteed underperformance against the respective benchmarks if you're going into an ETF or an index fund. The only reason to go there is easy to understand and the costs are lower, but you will never get outperformance. So I would say as an investor, you need to look at both active and passive. You have to evaluate both depending on your risk level and depending on the expected returns. Because in actives, while the cost could be slightly higher, if you look at the long-term track record of not just Kotak Mutual Fund, but of the entire Indian mutual fund industry, majority of the funds, even after accounting for that higher cost, have beaten the benchmark handsomely, right? So you may pay slightly higher cost on your investments, but potentially they deliver better than benchmark. Yes, there are certain funds which have underperformed. There will again be phases where in certain phase, certain funds will underperform. But if you have chosen a well-managed fund and if you stay for long term, more often than not, you are going to get that expected outperformance. So on one hand, you have slightly higher cost and a possibility of outperformance. And if you look at the past several years, the track record is in front of you. On the other side, you have lower cost definitely and 100% guaranteed underperformance. So which one you want to pick and or how much you want to put in these two pools, that's a choice that an investor has. But according to me, India is an emerging market, and in emerging market, new businesses will keep evolving. There will be new businesses which will get listed, new small businesses which will grow big, etc. So where does the outperformance come from, right? Let's say simply for a certain fund, Nifty 50 is the benchmark. So you have to beat the performance of Nifty 50 stocks through your portfolio, right? If there are certain stocks which are not listed yet, which will come and get listed over the next several years, let's say, and they are from emerging sectors, and you invest in them before they come into the index, there is a long period of time. If in that period of time they do better than these Nifty 50 stocks, for example, then that adds to your outperformance. Or if you take the same Nifty 50 stocks, but in a different proportion, because your research says XYZ company is going to do better than the other company, that also can lead to outperformance. So there are different ways of creating that outperformance, and all our research is therefore focused on finding good businesses at relatively better valuations. That's what we try to do in our portfolio. But having done all of that, there is still a possibility that we will underperform in a certain phase. But as long as it is cyclical and it's not a long drawn period, you should remain invested in those funds. And more often than not, you are likely to still get outperformance from actively managed funds in India, because India has a large pool of investable listed stocks, right? It's one of the largest in the world. Secondly, being an emerging market, there are more companies which are going to get listed, which means more options are going to be available. So with all of this, the research is going to play a critical role in delivering that alpha. And if you have right research and right risk management practices, you should be able to deliver outperformance. So I do believe that in India, even at these levels, there is possibility of delivering outperformance. But I take your point, as asset sizes grow, as market matures, the extent of alpha may go down. For example, few decades back when I started my fund management, getting 8-10% outperformance on the respective benchmarks was relatively easy, I would say. Even with lesser experience than what I have today, it was easy then because market was less institutionalized. So finally, you are competing in the same market where all kinds of investors are there, right? When every investor becomes equally good, then the alpha generation becomes less, right? So as market becomes more institutionalized, larger in size, then obviously that competition will increase. So your extent of alpha will go down. Today, getting probably 2 or 3% outperformance against respective benchmarks has become a good outperformance. So extent of alpha definitely has come down in last several years. That's going to happen in every market which sees more institutionalized players coming into the market. But because of the reasons that I mentioned in terms of how evolving India has been in terms of an economy, I still believe that active fund performance can still generate that outperformance, at least in the foreseeable future.
Great. I keep telling our investors the fact that this fund will underperform, it also leads to outperformance because it's never a linear growth, right? It cycles. As you said, as fund managers identifying great opportunities, it may take little time for that
Correct.
opportunity to play out. At that period, you will have a underperformance. It does not mean that you will remain
Or
underperforming.
sometimes the investment decisions may not be right, but there is always a corrective phase. The investment managers are also changing their stocks and proportion. That can also lead to comeback in performance. So it could be different reasons. So definitely it's not a permanent thing. If it is sustainably long period of underperformance, obviously you need to investigate and see what is going wrong.